Let's begin with the numbers. Since 2023, the US unemployment rate has climbed steadily from 3.5% to 4.4%. Non-farm payroll data shows the economy lost 92,000 jobs in February alone, a clear signal that the labor market is under pressure. The headlines are striking. On March 31st, 2026, Oracle announced layoffs of 20,000 to 30,000 employees, roughly 18% of its workforce. Earlier, on February 26th, Block cut about 4,000 positions, representing nearly 40% of its staff. And as of mid-March, Reuters reports that Meta plans to reduce its workforce by approximately 16,000 people, around 20% of the company. This is not an isolated phenomenon. It's a trend, and it's accelerating. What is driving this? While the causes are multifaceted, two forces stand out: artificial intelligence and rising energy costs. Together, they are reshaping the economy and the labor market in ways that are structural and enduring. Energy, the invisible tax on the economy. Oil is more than fuel. It is embedded in nearly everything we buy: our clothes, electronics, transportation, even food. When energy prices rise, it triggers a ripple effect across the entire economy. Production costs increase. Transportation and logistics become more expensive. Corporate margins shrink. When companies cannot pass these costs on, they adjust where they can, most often through labor. The effect is systemic. Rising energy costs exert pressure across industries, quietly but persistently increasing unemployment risk. Artificial intelligence, redefining the nature of work. AI is rapidly evolving into a force capable of reasoning, decision-making, and execution across domains once considered uniquely human. Its impact is no longer theoretical. It is already reshaping the workforce. From software engineers and accountants to drivers and segments of the medical profession, AI is redefining the nature of work. In software development, for instance, AI can now write code, build end-to-end systems, manage deployment, and even diagnose and resolve bugs in real time. As a result, much of the traditional entry-level workload is being systematically automated. The pattern is increasingly clear. Roles centered on rule-based execution and predictable task flows are the most exposed. Over time, these effects will propagate across industries, fundamentally redefining the employment landscape and the distribution of human labor. Can the Fed mitigate this? In theory, lower interest rates should stimulate hiring by reducing the cost of capital. Yet, despite a rate-cutting cycle that began in late 2024, unemployment has risen from 3.7% to 4.4%. Part of the explanation lies in policy lag. Monetary policy is a blunt instrument, typically requiring 12 to 18 months to transmit meaningfully into hiring decisions. However, cyclical explanations may be insufficient. Structural forces, potentially more powerful than conventional policy tools, are emerging, with job displacement occurring faster than policy interventions can offset. As of April 1st, the CME FedWatch tool indicates a 98.4% probability that rates will remain unchanged, a 1.6% probability of a hike driven by inflationary pressures, particularly from energy, and no expectation of an imminent rate cut. Beneath this surface consensus, a more strategic debate is unfolding. With U.S. national debt approaching $40 trillion, some investors argue that the Federal Reserve may ultimately tolerate a degree of currency debasement, allowing inflation to erode the real burden of debt while easing interest costs. In this context, a resumption of rate cuts later in the year appears increasingly likely. The Federal Reserve now faces a fundamental trade-off: fight inflation or support a weakening labor market. There are no easy answers. Even with rate cuts, unemployment is likely to keep rising as old economy tools struggle to contain new economy disruptions. What should individuals do in this environment? First, position yourself for the AI transition. As AI automates routine tasks, it simultaneously drives an urgent need for professionals who can translate technological capabilities into industry-specific solutions. Across sectors, from healthcare to construction to finance, organizations are seeking individuals who can apply AI strategically to real-world challenges. This demand is giving rise to a high-value role: the AI strategist. Building expertise in AI is no longer optional. It is a deliberate, strategic investment in your future career. Second, shift your investment focus to real assets. In periods of economic uncertainty, tangible assets such as gold, silver, industrial metals, and key raw materials serve as a protective shield. These real assets act as hedges against inflation, currency fluctuations, and systemic volatility, helping preserve both capital and purchasing power. Third, cultivate irreplaceable human skills. AI excels at processing data and executing algorithms, but it cannot replicate trust, leadership, negotiation, or nuanced judgment. The most resilient and secure roles in the years ahead will be those that harness these distinctly human capabilities, making you indispensable in any organization. We are entering a fundamentally new economic landscape. Technology and cost pressures are reshaping labor markets, investments, and careers. Success won't come from predicting every outcome. It will come from adapting fast as the system changes. Those who anticipate these forces and act strategically will get ahead.